Good afternoon, coastal Southern California. I'm Jennifer Timm. I am a real estate agent licensed in both California and in Oregon. Excuse me. And as real estate wealth advisors, we help families grow, protect, and transfer generational wealth through real estate. One of the things that we aim to do is keep you up to date on what is happening at the national level, the local level, as well as looking at a couple of highlights from the global perspective. And then we always end with a wealth building tip. So let's get right in today. We have some great information. So it is December 3rd, 2025. Welcome to December. And of course, this is where smart money watches the market. Let's start off with our national outlook. Great news, because we're going to take anything we can get at this point. Mortgage rates are holding steady near 6%. The average 30-year fixed rate sits at about 6.23%, near 2025 lows, and definitely down from a year ago. So again, we're going to take that as a positive. Despite expectations for a Fed rate cut next week, markets and experts predict little immediate impact on mortgage rates due to already tight mortgage spreads. So for the most part, any anticipated Fed rate cut has basically been absorbed in to our current mortgage rates already. Rates for FHA and jumbo loans show only minor week-to-week changes. So the Fed cut odds improve, but market reaction may be muted. The odds of a December 10th Fed cut now sits at 88%, driven by mixed economic signals and delayed job data. Even if a cut happens, economists say mortgage rates may not fall sharply, as much of the effect is already priced in, as I just mentioned. Home sales and buyer activity begin to stir. So this is great news. Pending home sales rose 1.9% in October, with the Midwest leading due to better affordability. Existing home sales are up 1.2% month over month and 1.7% year over year, marking 4 consecutive months of year over year gains. And purchase mortgage applications are up 26% year over year, showing signs of renewed buyer confidence. That is a good thing. We're definitely going to celebrate that. And then adding to that, builders offer incentives amid rising inventory. 41% of builders are cutting prices, up from 30% in Q1, to attract buyers as inventory builds. And new construction is helping to relieve supply pressure, especially in the South and the Midwest. Affordability is slowly improving. The Housing Affordability Index rose to 104.5, meaning a median income household now earns more than required to buy a median priced home. Again, not necessarily in every market across the country. Monthly mortgage payments dropped 1.3% year over year and are expected to dip below 30% of household income for the first time since 2022. Again, that's great news. Income growth is outpacing home price appreciation, easing pressure on buyers. Multi-generational living is on the rise again. 14% of recent buyers purchased multi-generational homes, primarily driven by affordability, caregiving needs, and adult children returning home. These arrangements are also financially strategic, with more households combining incomes to qualify for home ownership. Younger buyers are back. More good news. Buyers under 40 now account for 44% of new mortgages, a level not seen since the year 2000. Their return is being fueled by declining rates, modest price growth, and improving job confidence. So I kind of feel like this national outlook is the most positive in a long while. So it's really good to see all these great indicators. Our mortgage rate watch, from Mortgage News Daily, which we get at 1 o'clock Pacific Standard Time as soon as it's released. So 6.23% for our 30-year fixed, and our 15-year fixed is 5.75%. And Their headline mortgage rates back down near recent lows. So mortgage rates improved more noticeably today. And while the average rate isn't quite as low as it was last week, it's fairly close. Rates are based on movement in the bond markets, and bonds were most likely to move in response to one or both of today's big economic reports. Oddly enough, most of the bond market improvement was seen overnight before the economic data came out. Nevertheless, the data definitely didn't hurt. So all round, excuse me, it's that time of the year. My allergies are just kicking up. We are seeing some great things happening. So let's see what that smart money insight is. The housing market is quietly repositioning for a rebound, with mortgage rates hovering near 6%, income growth outpacing home price gains, and builders cutting deals. Savvy buyers and investors are re-entering the market before the spring rush. The smart money isn't waiting for the headlines. It's watching the fundamentals, which are steadily improving. And just a comment about the headlines. There are some folks out there who are not housing analysts. I am not a housing analyst. I am a real estate expert. But be careful who you follow, because there's doom and gloom out there saying that home prices are going to be slashed 50% and it's going to be the worst thing since 2008. None of the indicators are pointing to that. Everything looks like we're going to be entering into a recovery stage. Will we see the super low 3% mortgage rates again? Highly unlikely, because if we do, it means we have some kind of global catastrophe again, which I'm sure you would agree none of us need. Moving on to our local market spotlight, starting with Capistrano Beach. Median list price is up to, it's still just under that 4.4 million, so a slight increase there. Price per square foot, 1,123, unchanged. Only 20 homes on the market, which is decreased. And median days on the market is down to 105, with a market action index of 33, so a slight seller's advantage. Capistrano Beach shows early signs of a market turnaround, with that MAI ticking upwards. And it did remain the same as last week, but it's inching. With prices still soft, savvy buyers may have a short window to negotiate before momentum shifts upward. Watch for sustained MAI growth as a cue to move. Dana Point. Median list price, just under 6 million. Price per square foot, 1,765, which is down. Our inventory, 40 homes on the market. Median days on the market is 88, with a market action index of 40. So this has come up a couple of points. Prices in Dana Point are quietly climbing amid low inventory. Again, reduced inventory, higher demand tends to start pushing prices up. With no recent price increases from sellers, this could indicate hidden value. Smart investors should act before pricing reflects the market strength. San Clemente, our median list price, just under 2.5 million. Price per square foot, 910, which is up. Our inventory's down to 83, median days on market down to 84, and our market in action index is also up to 40 and a slight seller's advantage. Despite solid demand, nearly half of listings have had price drops, creating rare buying opportunities excuse me, in a seller's market. Smart money is watching closely for value amid the noise. And finally, San Juan Capistrano, our median list price is down slightly. It's now at 1.874. Price per square foot, 747. Inventory's down to 32. Median days on market is 28. 28 days. It's crazy. Our market action index is 50. Again, I mean, this is a strong seller's market in San Juan Capistrano. It's heating up fast, with homes moving in under a month. I mean, 28 days. We haven't seen that for a while. With rising MAI and shrinking inventory, buyers waiting on the sidelines may miss out. Time-sensitive action is the strategic move here. Watch your feed for data for some of the other areas we cover. And our global perspective. So this decided to kind of take this in a little more detail. So there's a couple of slides of this, and we're just going to kind of catch some of the highlights. You are welcome to come back and read this in more detail in your own time. So global real estate markets are at a turning point, and now's the time to scout value. So key macro and market trends. Global real estate values appear to be stabilizing after a recent downturn, and institutional and private capital is returning to core and income producing property sectors. Opportunities exist outside traditional hotspots, so that's always important to watch for. And then global macro trends support a more predictable investment horizon. So remember last week we talked about foreign investment coming back into the US. This is more of looking outside of the US. So strategic implications for US-based investors. Diversifying into global real estate can reduce exposure to those domestic cycles and tap markets where currency growth or yield favors foreign investors. Investing in income-producing properties globally may offer stable cash flow while US housing remains competitive. And for investors already holding domestic properties, globally spreading risk can act as a hedge against potential US rate or price volatility. So where are these top markets? Again, lots of information here. I am not going to take you through all of these, but there's some pretty attractive looking locations worth having a look at to see if there's something worth diversifying your investment portfolio. And of course, as a certified international property specialist, I can assist you and connect you to reliable, certified real estate experts in each of these countries to ensure that you have a wonderful experience. So our global perspective, smart money insight, global real estate is no longer just for the ultra-rich or passive investors. 2025 marks a tactical entry window. Those who move decisively and build a diversified property portfolio across geographies and asset types may set themselves up for long-term yield and growth, while the herd is still cautious. I like that. And talking about investing, this is going to be our wealth building insight. So it's a little more of a mindset shift, and it's around the concept of if you are an investor and you own real estate properties that are supposed to be bringing you income, what we are finding is that many of our investor landlords have no clue how their properties are performing. And actually, they're very complacent about, well, I've got a tenant in there, they've been there for a number of years, I'm just good. Meanwhile, they're leaving money on the table. So this is your, sort of reminder that your investment property isn't just an address. It truly is a business. And it's in your best interest to start treating it like one. So that's that mindset check. Too many investors don't know how their properties are performing in today's market. They don't track cap rates or cash on cash returns. They tend to pay for repairs out of pocket instead of making the property, the business, pay for it itself because they haven't put any CapEx reserves in place. And many think it's fine, the tenant pays on time, but that's typically leaving a lot of money on the table in today's market. So a question for you, if you are that investor who's a little kind of laid back and, everything seems fine, if you looked at the numbers for the property that you currently own with a view that, would you buy it again? Do you really understand what your actual yield is? Are you charging market rent or doing your tenant a long-term favor? Remember, they're the only ones that you're doing a favor if you're doing that. And is your equity working for you or just sitting? Another one I didn't put in here is your depreciation. Have you maxed out your depreciation? In which case, again, you're leaving money on the table. So your action plan, Think like an asset manager, not a landlord. Track performance annually and not just when leases end. Plan for turnover, capex, and market shifts before they happen. Again, this is a business. It should pay for itself. It should be yielding you the income, the best possible income, and they aren't, in our experience from working with investors, they are not always doing that. So, your smart money insight, complacency is expensive. And if your property isn't performing, it's time for a portfolio checkup. So, your call to action, this is what I do all day, every day. I help clients understand how their properties are performing if they're investors. And we call that an asset performance test. We will look at your cap rates or cash and cash return. We will help you identify what your potential capital gains tax liability could be if you sold. And then we also help you, together with your financial team, come up with a plan to defer or eliminate any capital gains tax liability. So please do yourself a favor and your family a favor and book your investment property performance review today. Call me, email me, respond with a comment, and I'll reach out because that's what it's all about. This is what I do. So if today's brief sparked questions or inspired a next step, I'd love to connect. There's my phone number and email. And it's all about what your goals are. We'll ask you 1,000,001 questions. We'll run numbers for you. And then it's your decision what you choose to do with it, whether it's your primary property or an investment property. And just that final disclaimer that the information we provide should not be construed as investment tax or legal advice. I am not an attorney. I am not a CPA or a financial advisor. And we always want to make sure that you know that whatever information you choose to take from today, definitely, if you're going to put it into action, let's work together with a team, with your team of legal, financial, or tax advisors, and make sure that you have a great real estate plan, because we believe that your legacy begins with that real estate plan. And that is the end of our midweek market brief for this first week of December. Stay warm and just have a wonderful week. I will see you next week at the same time.